Thank you so much, Vaibhaw, for the kind introduction of ours, and thank you everybody for taking us time and finding it and coming on board on this webinar. And as in, now we can quickly start it. As my friend Pankaj has rightfully and precisely explained what the contract is as an arrangement between two or more parties, providing for the set of promises of each of the party. So contract is not the one we write on paper, as he rightly have said, and it is like any oral contract is valid, and the contract is what we do in everyday's life of ours, like buying vegetables from the market, and during this lockdown situation is like doing an arrangement among the family members for doing the household work. So contract is we are doing everywhere at every stage. And likewise, investment document is a contract among the investor as well as the founder, where the investor, let me go through the presentation as well, where the investor proposes to buy and the founder wishes to sell the property of the company, that is a share. So it is a transaction of purely of sale and purchase. However, advancing money by an investor is a critical task and requires a detailed analysis by the investor of the company where it is investing in, and it is always on the basis of object of the investor, that in what kind of businesses the investor is open to invest, as well as the profit. Profit is the most important motive of the investor, and also the exit strategy from that particular business. Investor will also look for utilization of the money which has been advanced by it into the business, whether that money is always being used in the business, or so that the information rights are there with respect to that investment which the investor has made into the business. So while investing into the business, every investor will look for all sort of rights, whether that would be essential rights for its protection, or whether that would be the advanced rights which a founder is always required to negotiate with the investors. Like at the time of investment by the investor, based upon the value or the price it is at which it is investing, it will always look for protection of rights. So protection would be in the form of price protection, or it would be in the form of protection from the dilution, or it would be in the form of any exit strategy. So here, and the investor has money with it and has lawyers to represent with it. So, and it always look for the rights, and the investor have all the rights with respect to, wishes to have all the rights with respect to any investor document, where the founder where founder tend to make mistakes by simply signing the document because they are receiving the money. And of time, they should understand the future implications of signing a document without going through that document. And just it is to mention that investors always are open for any discussion or negotiation, because investors always look for the potential for profit and the potential of the business. And the investors, if the investor sees that potential, then investors would always be open for negotiation. And negotiation is nothing like that which is to be studied or which is to be acquired. It is like we are doing negotiation in our daily routine, starting from the while we were small, like in the childhood, we were doing with our parents, and we grew up with friends, then with teachers, then colleagues, then bosses. So we are doing these kind of negotiation at every stage, and during during our entire lifetime, we are learning this skill. So it is like we have to apply that skill while discussing any document with the investors. And like now we quickly go through the strategies which requires to be followed, and that would be in the form of essential ask of the investor. Like investor would always look for certain rights while investing, because that investor wants to protect, and there are certain advanced rights, or we can say the negotiable ask, which we as a founder need to negotiate with. So also we should always be fair while negotiating, because investor is not like he would be investing only in business. He would also be investing in the founder, who is the brain behind it and who would be carrying on the business and the other business and running the business, thought of that investor and the nature of that investor and the fair dealing with which the founder would be dealing with. So there are certain essential asks. Let me take you through that slide. Okay. So I'll take you to a tour of the essential asks. Essential asks are certain rights which investor will always look for to protect itself from loss in value with respect to investment it has made. That would run from the anti-dilution, that would be the price protection, then that would right of first refusal, tag along right, or the preemptive rights, or there are certain other rights which investor will always look for to protect its interest. So anti-dilution is something that which the investor wishes to protect its price at which the investor is subscribing. That is a kind of a price privilege which the investor look for. So suppose like if investor invest at a price of 1,000 rupees of share, and after few months there is a new series coming in into the business, and that new series there is a down round, there is some loss in the business, or business like the new investor wishes to invest at a lower price, so that is a down round. For the upper round, if it is more than 1,000, then investor is always happy. So in a adverse situation of down round, if supposedly new investor is coming at 800 rupees, so that 200 rupees is the margin. So the earlier investor always look for that to protect it from that loss of 200, and look for the adjustment to the price at which it has invested previously, and will have again fresh issue of shares, or the transfer from the founder or number of shares, so that his price also be adjusted to the 800 rupees as that of the new investor. And where there are number of series of investments, where the founders tend to make mistake is like they used to provide anti-dilution to all the investors at the subscription price, at the highest of the subscription price. So here the founders would have to look into and have to restrict or negotiate it to restrict the anti-dilution with respect to subscription price of the investor at which a particular investor has invested. Now, how the investor would be getting the new shares adjustment? If that is a foreign investor, there is a challenge under FEMA. You can't issue at a price which is lower than the fair value, and here we are asking for the free. And again, there would be tax liabilities that would be coming on the investor with respect to this getting the shares against the anti-dilution. Now, another one is the preemptive rights. So this is a kind of subscription privilege to the investor, which investor look for. Like this is similar to the right issue, wherein as investor has invested into the company, investor will always look for that he would have the first right to apply for the shares to participate any offer, so that its shareholding won't be diluted. So it is a protection against dilution of the shareholding of an investor. So here, and if the investor does not participate, then board is open to issue to the third party, so that the business should have funds to do the business. So another is the right of first refusal. So this is a kind of okay, I'll tell you what is the right of an investor is the obligation of a founder, and what is the right of a founder is an obligation of an investor. It goes vice versa. So here in an investment document, there is a transfer privilege where investor will always look for, okay, for this is applicable on the founder, where the founder wishes to sell any part of the share, then investor will look for, okay, if you want to sell, then prefer me. I would be buying those shares. You need to offer that to me, not to the third party. I should be the first priority. So founder is like, okay, I would be offering you, but the terms would be same at which I would be offering to third party. For example, if I am getting 2,000 rupees from the third party, so I'll ask 2,000 from you. If you are okay, then you have the first preference. So investors would always be fair here. Investors are always fair here and agree on that same terms. However, in a case where the investor tend to make mistake here is like, sometimes it happens that agreement is worded like that if even in a investor wishes to exit, so then other investor asks for the right of first refusal there. So it should first be applicable on the founders only, and if the investor is not acquiring, then it will go to third party. But there again, there is a tag along right. Investor will look for always, because investor invests to exit. Investors invest to earn profit. That is the only motive which the investor have always in their mind. So tag along right is something where investor tag its shares, right? So if the founder wishes to sell any of the shares, then investor has to offer first under right of first refusal to the investor. However, if investor does not wish to buy, or investor does not found it feasible, or investor does not have money, so investor keep itself the second right, that's the tag along right. So under tag along, if investor does not invest or buy, the investor tag its shares as well with the shares of founder, so that if founder sell to a third party is under obligation to acquire the shares of investors as well. Now, the common mistake which the founders make here is founders provide the absolute right of tag along. Like if founder is selling 5% of its shares out of his total holding, and the agreement words like that, the investor would be having the right to sell all of its shares. So here it is to be seen and discussed with the investor. Okay, I am selling 5%, so you would be also be selling the 5% in proportionate to me. It should not be an obligation. Otherwise, what would happen? A situation will arise that even the founder won't be able to sell any share, or investor won't be able to take exit. However, as an for the founders, as an exception to that, what founders tend to make mistake is like they do not ask for any affiliate transfer. Affiliate transfer is one where it's a part of succession planning as well. Like if I wish to transfer my share to any of my family member, to my brother, sister, daughter, son, or to my parents. So if I do that, then I have to go through the entire process of right of first refusal, tag along rights, and other rights which the investor has. And sometimes it would be difficult, or it would be prohibitory for me if the business good. The investor won't allow me to transfer to any of my family member as a part of succession planning. So we always look for, an investor always agree to this if that percentage is small, because as an industry practice that should not be more than 5 or 7% of the total transfer. So we have to have that right with us, but this would always become with the condition that it is the founder who would be controlling the voting in those shares, and there would be transfer of only the shares and the beneficial right to the affiliates, and not the voting rights, because investors have invested into not the business but also in the founder of the company, who is the brain behind it. So these are some of the price protection rights, or some of the this anti-dilution rights of the investors. So another one is these are some of the price protection rights, or the rights with respect to protect the dilution of shareholding of the investor, where the founders also have to take care of and look for to protect themselves, so that there won't be any absolute rights to go in favor of the investor, and the founder can protect themselves at always in the near future. And I believe even the screen is checked. So there are other rights. One right is specifically with respect to the startups, where the investor will look for the lock-in rights. Again, that is fair, because as I mentioned, that it is the investors who will be investing into the brain behind, into the founder. So they will look for that founder should stay into the company for 4 or 5 years, and that is pretty fair. And however, as a founder, we can ask for the unlocking of the shares in a proportion. Like, for example, there is a 4-year term of lock-in. So after a year or so, at every month, we will look for unlocking of some of the shares from the locked-in from the lock-in situation, so that the founders would be in a situation to sell part of the shares in the event they look for any liquidity, or if they are getting a nice exit or a better price in the market. Now, the most important part, as Pankaj has also mentioned, that is the exit strategy. So investors will first, at the time of investment into the business, look for the exit strategies from the business, so that because investor invest for profit, and always have in mind that after 4 or 5 years of time, they need to exit from the company and taking the profits along with. So exit strategy would be starting from the IPO strategy, the buyout to the third party, where the investor look for that the founder should ensure that there would be third party or new investor pitching in and for giving the exit to the existing investor at a profitable price. And if that is, and also there are some other rights which the investor look for. If the investor is unable to, founder is unable to found a third party, then they will look for that company to buy out. Again, this is always subject to financial feasibility. So that, and founder should always look into that, there should be financial feasibility of the company, and the right, and this should be mentioned in the agreement that any company buyout should be to financial feasibility. Otherwise, company would be in a insolvent situation, and that is a very adverse situation we all can understand. And third would be, if the company is unable to, then investor look for founders to give that exit to the investor by purchasing the share. And this is a kind of a very strict obligation on part of the founders, so that if they for them to give exit. So founders, as a founders, we have to negotiate and with the investor, that to avoid this right to be provided to the investors. And if that right would be there to be provided to the investor, then there would be some, that would be with some limitations with there. That is again the financial feasibility, and that should not act as obligation of the founder. Post that, if after that there would be a very a right which investor look for, that is a kind of very draconian right, which as a founder and as a company we always have to avoid. And that is a drag along right, which founders tend to make mistake and does not understand the implication and simply execute the agreement that they are getting the funds from the company. So drag along right is like, if we go with the literal interpretation, that dragging along with. So this is kind, if investors are not getting exit, and after 4 or 5 years of time investor wishes to exit, then they have the right to drag the shares of the founders. That is a mandatorily drag the shares of the founder. Founders cannot stop and sell to a third party if the investor found it. But investors generally do that when there is a third party or any competitor comes in and asks the investor for compulsory acquisition. So in that particular event, what happens is, like, investor drags the shares of all of the shares of the founder to the third party, and the founders are out of their business. Founders are out of their dream. So these kind of situations are to be avoided with. So here the founder should be very cautious that these kind of rights, like obligation on part of the founder as well as these drag along rights, should be avoided from any investment document. Then the termination event, the events of default, there is a termination event investor will look for, so that they do not get cheated from the founders or from the company, or they won't be misrepresented at any point of time, or there won't be any fraudulent activity against the investment, against the money of the investors. So they always look for those events of default, like misrepresentation, the fraud, or the breach of any warranties, or the breach of any representations from the founders, because investors tend to invest on basis of those representations as well as those warranties. And if anything goes wrong with respect to that, then investors felt cheated. So here also, the mistake what the founders do, they simply sign the document. They should carefully understand what those event of default is, whether that would be with respect to the critical matters only, or that would be covering even the small things. Like if this happens, then that would be event of default and we will terminate. Because in such situation of termination, what investor look for is the rights in the event of termination due to those event of default. That would be put option right or the call option right, or they may look for any other rights similar to those. And call option is like investor call upon the founder to purchase, in such event of default, to purchase the shares of the investor at a particular price, or at a price higher than the fair value of that share. So in such situation, founder will get into very adverse situation to mandatorily give the exit. And again, on the other side, there would be another right of put option, where investor, if he looks at business is profitable and that has potential, investor will look for and exercise this put option right, where uh, just investor will put upon this. I just have mentioned mentioned that investor will look for after for deception to ask the investor to sell all of his shares to the investor at a price which may be at the face value or maybe a price lesser than the fair value of that share. So again, these situations are required to be addressed at the start of execution of the agreement only, and all the things should be carefully read and determined. And one more right investor always look for is the reserved right. So where and these reserve rights are generally being awarded, and our investors look for where they have they are investing more than around 15% or 20%. That is standard. However, again it is based upon the cap table of the company. Even the investor with 10% of the investor will look for this right. So that again is to be carefully studied. Where but those reserved rights are those where uh, there is an affirmative right in favor of investor, and these rights generally include the further issue of shares, which may have the effect of dilution, liquidation of the company, merger of the company, or any advancement of money by the company, or any obtaining of loan into the company. So these are the rights which either have a direct impact on the business of the company or direct impact on the basic structure of the company or financial condition of the company. So in these, investors will look for the affirmative voting right. So if any of the thing is happening in the company, then you tend to ask for a permission from my side, and if I confirm, only then you would be able to exercise that right or do that event. So this is basically the outline. Sorry, in the paucity of time, we needed to run through this, and so this is the outline of the entire founders' entire investment document, where founders as well as investors will look for certain right to protect their interests and to avoid any adverse situation in the future, and always look for their profits. So I wish that I now are required to sum up here only in the interest of time. So over to you, Vaibhav.